All right, welcome back to Yahoo Finance Live. Miles Upton here in New York. It's time for Retirement Ready, brought to you by Fidelity Investments. Today, we are joined by Peter Mallouk. He's the president and CIO at Creative Planning. So, Peter, I guess let's just start with your assessment of the environment and what it means for longer-term investors. We can obviously debate whether we're going to have a retest of the low, what April was all about, but I think long-term investors had 5-6 years of the market mostly behaving, and then everything kind of went haywire in 2 months. If you're a retirement saver, what should your mindset be at this time?
Well, I think there was a world at one point without coronavirus, which a lot of people forget. So when people are predicting, say, the shape of the recovery, we were talking about earlier, is it going to be V-shaped, U-shaped, all of those sorts of things. We're talking as if there's nothing else in the world besides coronavirus. And even in a world without coronavirus, the market is negative 1 in 4 years with an average drop of 14%. And you have a bear market on average every 5 years. If you look at the last 20, tech bubble, 9/11, 08, 09, and this, we're right on track, 4 in 20 years. So a long-term investor knows this stuff is going to happen, not coronavirus in particular, not 08, 09 in particular, or 9/11 in particular. They know things are going to happen. And so they've got a period where they're working, or if they're not working, they've got a period of their portfolio where they've got bonds and other conservative investments to cover their needs. So they're not concerned with, are we going to recover in 3 months or 2 years? If that's something that is impacting your retirement plan, you don't have a good retirement plan. You need to have a retirement plan that can account for very negative things happening over the short run.
So a lot of is out of your hands when it comes to retirement in the market. You're just in the market and you're going to see where this train goes. But you can make decisions along the way. And one that I'm trying to figure out has to do with the required minimum distribution. And this is under the CARES Act. If you don't need to take your RMD this year and you leave it in, do you have to take it any other year, or are you just going to get a pass on that year overall?
Yeah, I think this is like new information to a lot of people. There's so much that has changed with the 401k and IRA rules that were already, in my opinion, way too complex to deal with. You shouldn't have to talk to a financial advisor or CPA to figure out what to do with a plan that so many people have. You can now borrow from the plan. You can skip your RMDs, and if you're 70 and a half, you don't have to take them. You can wait till you're 72. If you took them from the plan, in some instances, you can return the money to the plan. And then there's some plans like inherited IRAs where you can't defer taking it. So be very, very careful with everything to do with the RMDs, with IRAs, because the penalties for doing something wrong are very severe. I mean, some of the penalties are as much as 50%. But everyone, to your point, should be looking at all their options available with a 401k plan, getting good tax advice to make sure they make the best decision for them. One general rule is the longer you can leave money in a 401k plan, obviously, the better it is, because you're deferring the taxes into the future and you're not paying taxes on the investments in the meantime.
Peter, just thinking about the layman here, so often on this show, we have great sort of talking points where will it be a W recovery, a bathtub, a swoosh, a U, a V? But for the average person who is just trying to figure out whether they can retire safely and with enough money in the bank, do you think that sort of distinction matters? How are people kind of recalibrating their thinking based on what kind of recovery it will be?
Well, I think that in terms of talking about the recovery from an investment standpoint, what kind of, say, shape it's going to be, the swoosh, VU, whatever, is all preposterous, right? Because when we look at to predict what shape it's going to be, we are taking the variables, go into this calculation, and that gives us a probability on the other end. But we don't have any certainty around any variable. Okay, we don't know what's going to happen in the summer. Will it pause? We don't know if it'll be back in the fall. We don't know if you have antibodies, if you're not going to get it for the rest of your life, or you're just going to get it next season. We don't know which of the 500 mutations are going to happen, and are they going to get considerably worse? We don't know when the vaccine is coming. We don't know how well these treatments are going to work. If you don't know those things, you can't possibly have conviction on what's coming out on the other side. So it's a ridiculous proposition to be trading based on that information. Now, as human beings and Americans, we're obviously rooting for a V-shaped recovery, right? This is hurting a lot of people, and we want everybody to recover together. And the only way everybody recovers together is with a V-shaped recovery. Main Street gets back to work, they're investing in their retirement plans, and the stock market does well for all the people watching the show. With a U-shaped, what you can have in a very long U-shaped recovery is a lot of Main Street businesses, small businesses, which is 53% of American businesses are small businesses. That's what makes the country go. If all those restaurants close up and all those small businesses close up, stock market will still be okay. Walmart, Costco, McDonald's, Amazon, they're going to be fine. In fact, they'll be the beneficiaries of those businesses closing up. But there will be a harm to Main Street. And if it goes on too long, both lose. If Main Street's really suffering, then they can't invest, they can't save, and they cut back what they're even doing at places like Costco and McDonald's. So from a shape of the recovery standpoint, we care a lot as Americans, but as investors, if you're paying attention to it at all, you're not focused on the right things.
And I guess let's finish this way. Just thinking about, we got a lot of feedback there. Just what data points you're looking at on a daily basis now. I mean, I think everyone's world's been kind of turned upside down. And for a long time, there may have been a set of things that explained where today was at. I mean, what have you been thinking about trying to make sense of just what's happening right now? Forget about what happens in the future, but what is happening right now?
I'm one of those few people that thinks the market is perfectly rational right now and priced right where it's supposed to be. I know a lot of people think it's way undervalued. It's a huge buying opportunity. A lot of people think it's crazy overvalued. And I think based on the information that we're seeing as a collective of investors, that the market's priced where it's supposed to be. The very big companies that are the beneficiaries of this are doing well. I mean, you don't see the S&P 500 down a lot, and you see sectors within it positive year to date. Small companies that have loans and who are facing the existential threat here, they're down triple what the S&P 500 is. And then you have subsectors like airlines and cruise lines and all that. They're right where they're supposed to be too. And it's a perfect reflection of how much uncertainty and how much lack of conviction there is about how this is all going to unfold. And every time we get a new piece of information to put in the machine, the market's correcting that very, very quickly. And so, my attitude is none of this is actionable. You've got to stay focused on being a long-term investor, taking advantage of the drops by rebalancing when your allocation is off, placing tax trades, but otherwise not focusing on the day-to-day so much.
All right, Peter Mallouk with Creative Planning. Great to talk with you. Hopefully we can talk soon.
Thanks for having me.